In a dramatic turn of events, the US dollar to Japanese yen plummeted 2.5 yen to 156.50 during a tumultuous session marked by suspected interventions. After flirting with the 160 mark, aggressive rate checks from the Bank of Japan and the New York Fed played a pivotal role in driving the pair down. Today, we're diving into the timeline of this coordinated defense and exploring how Japanese bond yields reaching 27-year highs are reshaping the game for macro traders. As we approached this week, the yen faced immense pressure. Despite stern warnings from the Ministry of Finance, the markets were testing the waters around the 159 to 160 zone. With leveraged positioning heavily short on the yen and a significant interest rate differential, the outlook seemed grim. While JGB yields were gradually rising, the consensus held that the Bank of Japan was still lagging behind. Foreign investors cautiously held long positions in Japanese equities, all the while hedging their bets, waiting for a catalyst to reverse the yen's relentless decline against the dollar. What followed was a meticulously coordinated strike. We witnessed three distinct liquidity events. The first unfolded during Tokyo's morning hours right after Governor Kazuo Ueda's press conference. The second and third waves hit during the New York session, with market participants reporting follow-up rate checks by the New York Federal. This synchronized action hints at a high-level collaboration between Tokyo and Washington. It wasn't merely a BOJ solo act. The timing coincided with U.S. Treasury Secretary Scott Bessent's visit to Tokyo, where discussions about the destabilizing effects of excessive yen weakness took place. As a result, the pair plunged from 159.00 to a low of 156.50 in just hours. Back in Tokyo, the desks are buzzing with heightened alertness. An institutional analyst observed that the speed of the checks indicates the Ministry of Finance is no longer merely drawing lines in the sand, they are actively hunting stops. A structural risk analyst noted that the 30-year JGB yield closing at 3.835%, the highest since 1999, signals a significant shift away from the deflationary regime. Moreover, a leading Tokyo strategist pointed out that Secretary Bessent's proximity to BOJ headquarters during these critical moments cannot be overlooked, signaling a new chapter in G7 currency cooperation. So, how does this impact your screens? For the Nikkei, yen strength typically poses challenges for exporters, yet today, the index managed to rise by 1.3%. This divergence indicates a shift in foreign inflows from currency-driven plays to those based on valuation. Higher JGB yields are specifically benefiting Japan's mega banks, as the steepening yield curve enhances net interest margins. The connection is clear: rising rates are drawing domestic capital back into JGBs, which, in turn, supports the yen and shifts equity leadership from tech exporters to financials. The Japanese financial press, particularly the Nikkei, is shining a spotlight on the trade surplus data, which surged to 8.3 trillion yen, surpassing expectations. While Western headlines focus on the intervention, local media emphasize that Japan's strong current account underpins the yen's strength. There's also considerable coverage on the rate check mechanism being employed as a precursor to potential market intervention, a tactic designed to maximize psychological impact while conserving foreign reserves. Current positioning data reveals a significant squeeze is unfolding. Leveraged accounts that were comfortably short on JPY are now compelled to cover as the 157.00 level was breached. We're also observing signs of real money flows. The Government Pension Investment Fund, or GPIF, is in focus. Any shift in their allocation back to domestic bonds could be a major game changer. Meanwhile, retail margin traders in Japan, often referred to as Mrs. Watanabe, had been contrarian buyers of dollars, but the recent 2.5 yen drop has likely triggered significant liquidation. Keep a close watch on the 155.00 support level. If that falters, the 200-day moving average could become the next target. On the data front, the market is now pricing in a 77% chance of a BOJ rate hike in June. Stay alert for speeches from Ministry of Finance officials, especially for the phrase bold action. which typically signals actual JPY buying. Additionally, monitor the spread between 10-year Treasuries and JGBs. If the 10-year JGB yield stays above 2.5%, the pressure pulling US dollar to Japanese yen lower will only intensify. Looking ahead, in our hawkish scenario, the BOJ raises rates in June and confirms a taper of bond purchases, potentially pushing US dollar to Japanese yen down towards 150 as the carry trade unwinds swiftly. In our baseline scenario, we anticipate the BOJ will continue using rate checks and verbal interventions to keep the yen capped at 158, maintaining volatility within the 154 to 158 range as they await US inflation to cool. Conversely, in the dovish scenario, if the MOF's intervention fails to garner US support and US data comes in hot, we could witness a violent rebound towards 160, despite Tokyo's efforts. In summary, the US dollar to Japanese yen is currently facing the pressure of coordinated intervention, with JGB yields at generational highs and the 156.50 level marking a new line in the sand. Remember these key figures: 155.00 for support and 2.57% for the 10-year JGB yield. The carry trade is evolving, no longer a one-way bet. Don't forget to subscribe to Tokyo Macro Daily for your morning briefing on the key players and trends in the Japanese market. Until next time, happy trading!